Guys, welcome back to this channel. So today we are going to discuss true fair value gap, that is high probability. So this is my presentation, so we are going to start with looking at the definitions and then we look at how to identify a fair value gap using these scenarios here, and then we are going to look at key characteristics of high probability fair value gap, and then we are going to discuss the bonus, especially for the entry, and then the last part of this video is going to cover examples of a fair value gap trade setup on the chart, and then I'm going to also show you on the Telegram group, my free Telegram group. I don't have any private Telegram group that we share such trades. So the trades I'm going to show you here, they were discussed in the trading channel. Some were taken, some were not taken, so just be on the lookout. It's free, you can join it. The link is in the description section. So let's get started. Now, for fair value gap, basically is a fair value is a price area in the trading chart or order book where there has been a sharp and swift price movement, creating an imbalance or a gap. So this occurs when price moves so quickly in one direction that not all orders are filled, leaving a gap between opposing orders, that is the buy orders and the sell orders. So the gaps is the space. The gap is the space, as you can see in these examples. I'll illustrate in details. The gap is the space where the market did not have enough time to establish efficiency. So hence it created a gap which we call fair value gap. So that is basically the introduction part of it. And then I want you to note that this trading style is mostly associated with the smart money concept. ICT traders and maybe supply and demand traders also use it. So if you understand this concept, you're going to get high probability trades, because you will be obeying the rules that determines what makes a high probability trading opportunity, that involves filling the gap and then the price moves in the desired direction. Now, so how do you identify a fair value gap? So to identify a fair value gap, it's very simple, because fair value gap is identified by just looking at three specific price action pattern candles. So they are formed from three candles. That is why I wrote here three candle formation. And then so the most common and easy way to spot a fair value gap is by looking at the sequence of the three candles. So fair value gap cannot form without three candles from any time frame. Can be 1 hour, 15 minutes, 1 hour, 4 hours, daily. So it must be formed from three candles, at least three candles, to make it a fair value gap. The only thing that can form on two candles only is scope, which I'll discuss later. So let's proceed now. So there are two ways in which you can identify a fair value gap. Is that you can identify it in a bullish scenario or a bearish scenario. So for bullish scenarios, this as shown here, this space here is what is called a fair value gap. This one that is pointed by this arrow and marked by this Gantt box. So for a bullish, the first candle is bearish. As you can see, it was going down. So let me just do that a little bit. It was moving downward. The candle were moving downward. The candles were moving on a downward direction like that. So this candle was moving in a downward direction. Maybe it came from this side and then it was moving on a downward direction, and then the second candle is a strong bullish candle or up candle that moves up sharply. You can see this moves up sharply. The third candle does not overlap with the previous bearish candle's high, leaving a visible gap between the low of the third candle, that is the high of the third candle, sorry, the low of the third candle, and the high of the first candle. So this is the first candle, and this is the, let me just return this so that it can look neat. It's misbehaving. Yeah, here we go. So this is the first candle, this is the third candle. So this is the high of the third candle, the high of the first candle, and this is the low of the third candle. So you mark the low of the third candle and the high of the first candle. The gap between is what is called, the gap between that is brought about by the second candle is what is called a fair value gap, as illustrated here. Now what about for bearish scenario? Now for bearish scenario is very simple. The first candle here is the first candle is bullish, it was moving upward, up candle, and then the second candle is strong bearish candle, and see it moves downwards candle. So it creates a gap. Why? Because the third candle, this is here, this is the third candle, does not overlap with the previous bullish candles high. This here, this high here does not overlap to reach the low of this one. Very simple explanation. So the gap between is what is referred to as fair value gap, as I've illustrated here on this particular arrow. Now let's go to the key characteristics of high probability fair value gap. Now this high probability fair value gap, mostly I use 15 minutes to identify them, but you can use any time frame provided you combine at least two of higher time frame. Now let me give an example. Most people use one minute for entry, so your intermediate time frame becomes 15 minutes. You will still just use this here. So in that case, make sure that the 4 hours is aligned here and 15 minutes aligned. I will explain with examples to show how it is aligned. And then again, if you're using like myself, I use 1 day, and then I use 4 hours, and then I use 15 minutes, and then now I can go down to 15 minutes to get precision entry. But the price taps the fair value gap, or basically the order block. It doesn't matter. So what makes a high probability fair value gap? It must be inside high probability order flow. Now I'd already explained high probability order flow in this video. Just check in this channel, so just check, you will find one. And then again, it must have high probability order block. I've already explained here and uploaded a video explaining high probability order block, and is video with among the highest view by the time I'm recording this video. So go and watch it out, very informative like this one. And then it must have taken liquidity. So it must have taken liquidity is different from it must be backed by IDM. I will explain in the chat. So what do I mean? Must have caused a break of structure, and then it must be, as you can see in as you saw in the thumbnail drawing, then it must be backed by IDM, and then it must be backed by 4 hours direction, and then it must be backed by 1 day direction. Then immediately the price taps on the fair value gap, we go to lower time frame, let's say 15 minutes, we go to 5 minutes. If it's if you are dealing with 15 minutes, you can look for another change of character in 1 minute, or 3 minutes, you can go to 3 minutes also. but most preferably, if you're identifying these fair value gaps in 15 minutes, you use 5 minutes and find a single candle order block entry upon tapping. Now you can check my previous video of order block. You will find entries here that discusses fair scope entry, but if you are watching this video past maybe 2 weeks, you will realize that I've already uploaded a video explaining high probability scope entries, how I get scope entries. Now let me give you a simple snippet drawing of these characteristics that shows them in real action before we go to the chart. Now let's draw them together. Now let's say 15 minutes was selling, so 15 minutes sold here, and then something like this happened. So we get the first break of structure, and then even if it is weak, it's considered a break of structure. If you want to understand order flow, you must understand that wicks are even break of structure if you want to understand order flow. Otherwise, if you want to stick to full body break, you're not going to get the order flow, and order flow is the only thing that works in the market, because without a proper order flow, you will never find these things that I'm discussing. So the market causes a break of structure here in 15 minutes, then immediately it comes back in form of V shape and takes the high of this previous candle movement, or sometimes it can even just be within here it takes like this. There's no problem still, then it causes another break of structure. So to make this thing easy, let's just stay focused and say that this was the market broke structure here. So let's make it simple for everyone. So let's make it simple. So what happens here, let me explain using this diagram what just happened here. So 15 minutes was selling, and then it caused a break of structure, regardless of whether it is weak or body close. Body close is even better, weak is fine. Then it came back, raided the high of this. That is what is called taking liquidity. and then it caused another break of structure, but meanwhile it did a very simple thing. It delayed breaking structure and caused what is called structural liquidity, or IDM. So we get another break of structure down. If you see this is very high probability. So this is structural liquidity. So this becomes a structural liquidity. They are always less than 50%, or just exactly at 50% of the pullback. So this becomes a liquidity point somewhere down here. Gave reaction because smart money traders saw that this as a break of structure and then wanted to long from this point. Then it fails to long, so it gives a small reaction and then takes them out. That provides a very good opportunity for, again, traders who would wish to long traders who would wish to short from this point will get a small reaction. And then price goes to take them out and taps on the high probability fair value gap that is somewhere here, and then on top of that fair value gap you are going to find high probability order block like this. on top of that high probability fair value gap, you're going to find high probability order block that you're going to have an entry over. So criteria number 1 must be inside high probability order flow. High probability order flow is this. This is the high probability order flow. This here. Why? Because this order flow is high probability because it took the IDM of the previous candle move. At the same time, it is an order flow that broke structure down. So that means it is high probability. Go and check my video on high probability order flow. So that one is checked. The fair value gap is inside here. Number 2 must have high probability order block. High probability order block is above here, that took liquidity from the previous highs. It can be double like this, or it can be just from structural liquidity. Now I hope that is clear. As you can see, we are now building our case. So this is high probability order flow. Now next, it must have taken liquidity. This is the liquidity that was taken. So it must have taken liquidity, which is very, very fine. Let me put that there to avoid confusion. Good. Then next is that let me place this nicely. Next, it must have caused a break of structure. You can see it can be weak or it can be body closure, no problem. Next, it must have been backed by IDM. Here is a structural liquidity, very good IDM zone. Next, it must have been backed by 4 hours direction and must be backed by 1 day direction. Now if you go to daily, at this particular point of selling, daily was bearish. That is backing number 1, because we are looking at selling. So yesterday bought. That is confirmation number 1. Yesterday bought. This is daily time frame. Now if you go to 4 hours, if you go to 4 hours, you should be able to see something closer to this. So if you go to 4 hours, you will be able to see something like this. So this was daily. So daily has given you a range to trade on. So if you go to daily, you're going to find if you switch to 4 hours now, this thing should be something like this. It sold, market sold, and then let's say it pulled back. This was a buy candle. This was a buy candle. Hope I'm very, very clear. This was a buy candle. This was a buy candle. And then this. So you will be selling. You will be selling at this particular point, at the pullback of this candle here. So what will be happening? The 4 hours shall have aligned in your direction. So this is your 4 hours fractal. So it is like I want to squeeze this side so that it can be as realistic as possible. Bear with me. If you want the knowledge, you have to be patient. If you are impatient, then there are a ton of videos to watch for 8 minutes. So this one I'm showing here, so because there are people who really need it. It could be you. So just be patient a little bit as we make sure that everything is very clear. The days when I'll be making 8 minutes video are going to come, but not now when people need this knowledge that is not in the internet. So the days that I'll be shooting 8 minutes video, now you will be able to come, but you can just like it while you are waiting for the days. Anyway, I'm just joking, provided you get the knowledge. So what has just happened here is that this is the daily time frame, so we know that market should be taking this low. So overnight, before just London opened, depending on your time, before London opened, the market in Asia sold, plus part of New York yesterday sold, and then now it is buying again. And then now when London opens, you find it that it has already started taking the low of the previous candle, meaning that 4 hours has now began aligning in your direction. So if this low of the candle has been taken, and this is Asia close, this is the candle, the 4 hours that is leading to this is the 4 hours that is leading to New York, to Asian Open. So 4 hours just started forming and it's now pulling back. What do you expect? You expect that it is going to go down. Simple. So at this particular point, you have 4 hours backing with you. This is the meaning of backed with 4 hours direction. The market daily is selling, backed you up. 4 hours is selling. So 15 minutes, you're going to see something like this. So you will be selling here. Ideally, you will be selling somewhere here at the pullback here. And then the good thing is, again, you will be selling at even the 4 hours scob, which is just basically a pullback and then a push down. So you'll be having scob in your direction. The market is already aligning in your direction. So what do you expect? You are expecting this low to be taken and then eventually this low to be taken. So what happens in that case? The market just pulls back to tap onto this fair value gap, and then what do you expect? You expect that the market will move here and then take this low here. Will take that low, and that low will likely be if it is a long low, then it is likely going to be a very good trade, that is going to give you at least a good risk to reward. Now what happens is this: we don't just get into the trade like that when the market taps on the fair value gap and look to take this low. This is the major low that should be taken. It may fail to take the daily, but what is important is that you've gotten your 1 to 3, at least 1 to 3. So what do we do when the market taps here? You wait for scob, something like this, Let me delete some here. You wait for something like this to form. If the market taps on your fair value gap, it will be buying like this, and then immediately it taps on your fair value gap. What happens? It starts to sell immediately. So you wait to take your entry at the retest of this and stop loss above here. Then you look to take a 1 to 3. So you are selling when even the market has aligned in your direction. You are selling when the market has aligned in your direction. You don't need to wait for it to tap the order block, provided it's above there and then it is also at key time. Let's say London open. So the next candle is going to push to try and close this gap, and that is when you get your entry. Then you get your trade like that, like the one I got today that hit TP very fast in 15 candles. I've already taken my 1 to 3 plus. and then immediately start reversing, so that became none of my business again. So that was your 1 2 3. Now let's go to the chart and start with exactly like this. So this is the chart. Let's start here. Now anybody who has common sense, basically anybody who knows how to read market, that person has common sense. You can see that the daily sold yesterday. This is the day, this is yesterday. It closed bearish. That is correct. Next, 4 hours. 4 hours, this was the daily yesterday. As you can see, this is New York, this is London yesterday. So London sold, New York sold, and then overnight it pushed back. Now this is all overnight until the beginning of the day. This was the beginning of the day, of the following day here. So as you can see, the market has already pushed up in 4 hours, and now is taking the lows of the previous days. It has already even taken the low here of this other candle that formed yesterday and closed somewhere here. It closed somewhere here. It has already even taken the low. What happens? It pushed a little bit, took the low of the yesterday's daily candle, and then what happens? It started pushing back to where the market pushed. In 4 hours, you'll find that this was a sell, and then now this was a pushback, and then now the market has started selling in 4 hours. So what happens is this: the market came here, picked liquidity, that is criteria number 1, then broke structure, criteria number 2, then pushed back to create some IDM, and then pushed down to create second break of structure, confirming that now we are bearish, these 2 break of structure. Next, Asian opened, took the liquidity, and then took even when London opens, took the IDM, and what happens? It tapped on high probability fair value gap, the last fair value gap. If you are waiting for it to tap on the order block, you miss the trade. This is the order block, you miss the trade. This is a trade that I've already done a breakdown on it. Just check my videos on breakdown, you're going to find this trade, everything well explained. So this is the entry OB. So what happens? If you go to 5 minutes, you'll find a very beautiful scope here, and what happened? It just tanked immediately. There was a very good scope here, and you take it to your 1 2 3. It should have been provided at least a 1 2 3. So whether it pulls back is none of your business. Now if you missed that, you wanted more confirmation, is that we can see using order flow, the market, what did it do? It broke structure somewhere here. The first break of structure was this candle, then it pulled back, took this is valid pullback, you must know valid pullback, and then pushed down. This becomes IDM, but as you can see, there is no fair value gap here. So immediately it came back again, was about to break structure, came back, took liquidity, and then now moved rapidly. So again here there is a liquidity sweep, a break of structure that even caused this major break of structure. What do you expect? A pushback into the fair value gap. This gap here is what is called a fair value gap. If you go to 5 minutes, you're going to find a very good entry here, and then you get in at the pullback. This is 15 minutes, so if you get back at the pullback, you're going to find it somewhere there, stop loss somewhere here, and then you take it at least a 1 2 3, and then like in this case, it depends with where you got entry on. If you waited for more pullback, you got a 1 2 3, or if you didn't get a valid pullback, if you got in a little late, a little early, it must have taken you out on a break even, which is okay. So you can see it worked well. Now if somebody wanted to still use this fair value gap, we don't reuse fair value gaps or order block. As you can see, it gave you some small reaction, even from the OB after sweeping it during Asia, and then did not do anything, because this is reusing. We don't reuse things here. This is not an environment where we recycle, reuse. Now the following day, as you can see, it closed bearish. But now I want you to note one thing. There was no valid order flow, high probability order flow in this leg. But above everything, when London opened, Asia opened, and this 4 hours was so bullish, and at no point did it start to pull back. That means that the order flow was bullish, and therefore the only thing that could be bought here, could be done, is buying. But we cannot buy when the previous day was selling. That is shooting yourself on the toe. You don't know for how long, so you just ignore the trade and leave it alone. So eventually we started seeing stagnation, and then like you can see, there was a push, and then as you can see here, there is some push, and then again break of structure, and then IDM being taken, and then tap on low probability fair value gap that did not take liquidity, and then the market caused a break of structure. We don't take that trade because yesterday sold on a daily time frame. At the same time, 4 hours is still buying. So what is your business? What is your business selling? Like today, we are supposed to be selling gold. I've explained in my Telegram channel. Today is 19th, you just check. But gold is still buying on 4 hours, so we don't have any business selling. We just watch the market and see how it is playing. Maybe it is time for reversal, and then we will start buying again. So what happens here is immediately it took the high of this, it tanked down with the news. This was news, so we took this trade, but I took this trade on AUD USD, and I shared another trade on GBP USD and NZD. No, the GBP USD and NZD USD, just check on the Telegram. Took this and gave this perfect sell with the news, the GBP USD, and I took it on a GBP USD, and then also shared NZD USD. Again, when after news, what happened? There was a liquidity sweep, a push down. So this zone has already been mitigated, so we look for the next zone. The next zone is this becomes our third candle. Since it has an overlapping, we can just take it from this point. And then what is the third candle? This is the third candle, so the high of this and the low of this, so this becomes our fair value gap. So when the price taps on the fair value gap, you go to 15 to lower time frame, and then you get the sells. So if you go to 5 minutes, you will find here scope, single candle order block, and then what do? You sell. Sells worked perfectly, causing a break of, after causing break of structure. That is the main purpose of it. Whether it pulls back again, takes you out on break even, it has already done its purpose successfully. And you will see in most occasions when there is high probability like this, it must always break structure. Now the same trade here, I did not take it here on Euro USD. I took it on AUD USD. I've already explained that trade in the Telegram, in the Telegram group, and then at the same time in the YouTube. Just check, you will find that trade. I took it and got some good profit, at least it was more than 1 to 3. Why did I take it the other side? Is because I did not like this one, because it did not pull 50%. It barely pulled 50%, and that was not enough for me yet I was having another option of AUD USD that pulled to somewhere here. It means I was willing to take AUD USD because of high profit ratio. If I was selling from this point, from 5 minutes scope, and then expecting to see at least a 1 to 3, it was easy to get than to come here and then start hustling for tighter stop losses to take this here for a 1 to 3. So you can see, as much as it worked, but you needed to have a very tight stop loss, because the scope, I'm very sure, happened at this red candle here. So this was the maximum pullback it had. So if you check here, this is the maximum pullback. So unless you got it at the maximum pullback, but no, that is not realistic. in 5 minutes scope, we just wait for a reaction push back to retest the previous candle, and then we get in. So maybe we would have gotten somewhere here, and that would have maybe not resulted to a 1 to 3 risk to reward. So that is why I took the AUD USD one. Just check. Now the previous day, now we closed bearish, as you can see somewhere here. We closed bearish, meaning that we needed to look for more sells. So what happens the previous day? The previous day started selling, and then what happens is that this was not my trading time, but if this was London open, I would have taken this trade, because you can see it took liquidity from this candle, then caused an internal, this is all internal break of structure. First one, second one, left IDM, pushed back to this fair value gap here and order block, this here. And what happened? It immediately caused a break of structure down. Very nice trade, but it was out of the time window. So basically what I was looking at is to take low probability sells, but I think I took it on another pair, maybe Euro USD, I'm not sure, maybe other pairs. I have 4 pairs that I look at of USD, so I look at the one and take the clearest. So this was supposed to be where to sell from to get this continuation, because this is low probability order block, but at least I need to get the order flow going down. So I'm expecting that just a pullback and then a continuation. So this was a break-even trade, because if you took it upon tapping, you go to 5 minutes and get the scope. You got it somewhere here, stop loss just above here, so maybe you are stopped by spread, and then at least a 1 to 3. So you're expecting it to push there. Then what happens? Either break even or a stop loss. So this was a 1 to 2, it should go break even. So that was it. Very good. So this is an example of trade that this is low probability sells, but we would have waited for it because there was an IDM here, and then order flow is aligned, so would have taken that. The following day, as you can see, the market reversed successfully. We were expecting sells, but what happened that day? It gave some small reactions and then now started buying, meaning that the market is imperfect, and at some point you will be wrong. So it bought the whole day. We were just watching. There's nothing we can do because we can see clearly that the order flow is aligning on the bullish side. The order flow is really respecting. This is a break retest. So those who want to wait for full body closure, this is a break. And what happened after the break? Retest. The order flow is obeyed because the low was not even taken. That caused the break. What happens again? We get another break. So you keep waiting on full body closure. This was where is the low respected. Just keep waiting for the full body closure. Oh, that was not a full closure. Now this is the break. Again, what happens? Order flow is bullish, so not taken. You can see it went like that until overnight. Now we know that the market closed bullish. We need to be buying. Then it even caused a lot of breaks of structures upward. So what happens on London? We look at this. This is a push down, a push up, a push down, taking liquidity and then causing massive break of structure upward. Now what happens is that during Asia there was a push down, a push up. This is structural liquidity. So when London opened here, we were really looking for I was looking at a USD CHF trade. So I didn't take this. So when I came to the market, I realized that price was somewhere here. So I gave my people, the people we trade with on that free Telegram channel, I gave them this trade I'm going to show you shortly. Even the other ones, they are there in the Telegram group, you can check. So what happens here? The market came back. You go to 5 minutes here and look for scope. This is the whole order flow, but I just narrowed down to order block. So you start looking for scope upon tapping here. What happens? The market tapped on this fair value gap that is high probability because it has taken liquidity. It has a break. It is within high probability order flow, and is 4 hours is already buying. You can see this is 4 hours buying, and then at the same time the daily bought. So everything has aligned. When market taps here, what does it do? It gives a very good trade. This is an example of a similar trade I took today on a buy, which went very well. I was targeting 1 to 6, but it gave me 1 to 3 point something. Because of pullback, it went to like 1 to 5. Then it came back. You can see this is a very good trade if you got it. Now, I came in the market a little bit late, and I told them that this order block should be holding. Why? Because we had a push down and then a push up. If you know valid pullback, you will know this. And then a push down, that means that this was a liquidity sweep. Then a pushed up, pushed down, pushed up. This is structural liquidity. This is structural liquidity. So when the market taps on high probability, fair value gap, and order block here, you go to 5 minutes here. This is a trade I gave them. 5 minutes fair scope, and what did it do? It gave a 1 to 3. Very straightforward. So this is something that I took today. Something like this I took today, exactly the same. Now if you are looking to still take it like this, then you need to really have a lot of horse, because everything here has been reused. So if you're looking to take it here, you're most likely going to be swept, which is okay. Even if it gave a very good single candle order block on 15 minutes, but again it never held because everything else has been reused. Now I want to give you these 2 examples. So let's study here. Market pushed down, then pushed up again, took liquidity, caused a break of structure. Now when the market came back, there was no good fair value gap, but as you can see, the market held and pushed up, causing a break of structure. So if you are here and you wanted to get continuations trade, this was very good trade here. Go to 5 minutes, get this we never took, but just an illustration. Now when the market came back, as you can see, this was already reused and never took any liquidity. This price leg here never took any liquidity, so that is low probability. It gave good reaction and then came back, took liquidity from it, all of it. Then what did it do? Immediately took liquidity, to broke structure, internal one. 4 hours is bullish on this case, so we expect that this fair value gap to be holding, but then it doesn't hold during Asia, just mingles around. What happens when London opens? Sweeps everything, but I want you to note one thing: it respects, or it did not respect, it even swept the part that took liquidity. Why? Because this thing that took liquidity, this part that took liquidity, was supposed to be causing a break of structure, but it never did that. It was supposed to be causing a break of structure upward, but it never did that. So what did you expect? It had to be swept. So it was, if it caused a break of structure upward, this was just internal, so this was low probability. But most importantly, we don't just wait for it to tap and then we take. We wait for 5 minutes scope to form. If you check here, you're going to find 5 minutes scope on this price leg upward. So it may have pulled back or it doesn't pull back, but we don't wait for everything to be pulling back. Just wait for a reaction towards that pulling back, and then you get it. You can see 1 2 3. Now I want to show you this and give you and tell you that it doesn't always have to work. Now one is that we have a sweep of liquidity down here and then a break of structure. Nice. Now we have structural liquidity somewhere here, which is not, of course it's not a valid pullback, but this is the low, that caused this minor break of structure. So it's our structural liquidity. So the market came back down to it with momentum. This was news, and we don't trade news. Tapped on it, and what did it do? It just messed up everything, and then never gave good entry. So even if it gave entry, it stopped you out, and then the following day, after stopping you out, the following day it bought. This was yesterday. So some of our members took this. Me, I was not looking at this. I took a very good trade on USD CHF, which went to take profit. I'm doing a breakdown video after this video. So after this video tomorrow, maybe you watch at that breakdown. So eventually it bought and completed the cycle. So not all the time the trade is going to work on your favor, but as you can see, if you wanted to trade internally, this was liquidity sweep, and then what happened? This was a liquidity sweep, pushed up, causing internal break of structure, came down, got respected, pushed up, which is good. Again, the same leg, the trade that we showed here, this is the same process. This was another liquidity sweep here, leaving a very good imbalance down, order block with imbalance down here. So this is where we buy from. Now when London open, you go to 5 minutes here and then get 5 minutes scob, because the fair value gap is high probability, because it took liquidity, caused internal break of structure again. Now the previous day closed a little bearish, but we have characteristics to note that now we are buying. You can check that, just check in the Telegram group, you'll find reasons why this was valid. 4 hours here aligned, so this was just pullback, and then you go to 4 hours to 5 minutes, you get scob, and then you target your 1 to 3. So like today I was targeting to see this low being taken, same condition, but unfortunately it never gave me that, so I ended somewhere here. So you see it gave here, and then the same time the trade also played well again, caused a break of structure. This was a sweep, break of structure, and then a break of structure. These two, structural liquidity, market pushes down. You go to 5 minutes. This one yesterday I went there, but 5 minutes did not give us a good scope, did not pull back, and therefore this trade just went like that, and it caused a break of structure. So it would have given a very good another second entry, which we discussed I think yesterday on the Telegram group. That was it. Now so when it was coming back, it was very obvious that it won't make it, because structural liquidity was really poor here. At the same time, as much as it took liquidity here, you can see there was a build up of liquidity down here, and then at the same time news was coming. So this is not a good time to trade. News was coming, FOMC, so just be watching the market and then see what happens. So this was also another good trade. So this was FOMC time, so we wouldn't trade here, just look at the market. So today I took NZD-USD. This was the NZD-USD trade I took today, this, and you can see it gave me 1 to 3, and now it is pulling back, so it's none of my business. So as I can see here, there's no high probability places to be buying from. Now just check on my Telegram group here. If you are very keen, you can remember this trade just explained a little bit. This was me explaining it, and then this was it after take profit. So this was the intended take profit, you can just check. So this was me explaining. I give a lot of trades every day. I give my directions, I tell you what you want to. Today I'm not trading this. I give directions every single day. I also make stop losses like this, which is okay, but my directions are always right. It's only that sometimes I get stopped out. I get also hit BE if I get a little bit late. this was take profit, another take profit at BE. So I give daily biases on like this. So today's trade was this Euro USD. That was the trade. This is gold that is yet to play, and then this was the NZD USD. TP smashed heavily, so this is where I gave that I'm in. So this is where we explain that daily time frame experience change of character. So we are back to being bullish again. 4 hours range has not taken the fractal highs for buys, but we can get early entry since 4 hours is already taking highs of the previous 4 hours candle. So we can take early buys. You can take early buys upon the 15 minutes high being taken, or wait for pullback of the order flow, though the order flow don't look high probability. So this was a trade when immediately this high was taken, the order flow was bullish, and therefore I got my entry and got my trade here. If you can join, this is free. You don't have anything to sell you at the moment, so just join and see you there.